This is Chad Stayskull with Eagle Wealth Management with our educational economic update for March 2018. In this month's video, I'd like to discuss some of the major headlines that influenced markets in February. I also hope to provide you with some insight into what these developments could mean for you as an investor. U.S. stock market started 2018 very robustly, only to stumble in February. Both the S&P 500 and Dow had their first monthly losses in 10 months, breaking their longest winning streak since 1959. Overall, the S&P 500 and Dow both dropped around 4%, while the Nasdaq gave back almost 2%. These losses came as volatility picked up throughout the month. In early February, we experienced back-to-back stock sell-offs, followed by large jumps. During 1 week, the Dow lost 1,000 points and gained back 300 twice. This volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter GDP. At 2.5%, the growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. By the end of February, comments from new Federal Reserve Chair Jerome Powell led some investors to believe interest rates may, in fact, rise faster than anticipated. In testimony to the House Financial Services Committee, Powell spoke of growing global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued through the next day, as stocks whipped back and forth before ultimately ending down on the last trading day of February. If February's volatility feels unnerving, then it may be due to markets' unusual calm in 2017. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks only saw at most a 3% downturn from any new high reached. When considering last month's fluctuations, remember that positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectation and showed that people feel particularly good about the labor market. Jobless claims supported this perspective as new unemployment filings remain near historical lows. Moving into March, we will pay close attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates once again and provide greater insight into the expectations for the year ahead. As developments arise, we will keep you informed. Well, that's it for this month's Educational Economic Update. Please remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please feel free to give our office a call at 541-330-0220. Once again, this is Chad Stayskull with Eagle Wealth Management, signing off for the month of March 2018.